There's a few different ways to tackle college funding that offer tax advantages. We're going to be talking about the most popular ones in this episode. Welcome to the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
My name's Jane with Tech Exempt Millionaire Club.
And I'm Carlo Vaquero with Net Wealth Finance.
So, college funding. I've got kids that are just getting into college. I don't know about you guys, but we've had to deal with and think about college funding for a little while now. And I'm regularly in contact with clients that are interested in alternatives to the most popular tax-advantaged products, which is like your 529 plans. You can't put a whole lot into Coverdell's or some of the other things that might provide some tax advantages. But 529s is a different story and seems to be the most popular recommendation that you see from financial advisors these days. But we've got some good alternatives. What do you guys think?
I was a New York resident 2005 to 2007. At that time, we are so-called DINK, double income, no kids. So we did traditional IRA, which we could deduct the tax. We did the New York 521 plan, 529 plan, which is supposed to be one of the best for the state. And we can take the state tax deduction. So we set up that account with the future to have the kids to, at that time, we don't have kids, but we actually started using it when my husband went back to school. So we don't really have a lot of balance left after he used it. So that's my experience, 529 plan.
And I haven't personally used the 529 plan. I've considered funding it for various reasons, kids in private school and possibly funding for their college. But generally, I think my approach is going to be to probably open an IUL for each of my kids to sort of earmark some funds that could be used for college funding. And I think that's one of the advantages in my mind of doing an IUL is it doesn't have to be, and it's not limited by that, and you have opportunity for growth inside of an IUL that is tax advantaged, that can be used to fund college, or if the child decides not to go to college, maybe they want to do a real estate investment or other things that they might use to launch a business. So that's kind of one of the reasons why I've done some content on this, and probably why I've just opted not to fund a 529. I think there's various reasons why you may or may not. I've chosen not to, even though I do want to set my kids up for success and college funding at some time in the future.
So let's try and get into a little more detail on this stuff. 529s are like the most popular financial product. When a client talks to a financial advisor, they're going to most likely recommend put your money into a 529 plan. 529 plans are state specific. Each state runs their own 529 plan. And to get the best tax advantages, you basically have to participate in your state's 529 plan. Now, if you don't worry about the tax advantage, you can actually participate in any state's 529 plan, but it's not going to do you any good to save on state income taxes in New York if you don't have any state income taxes in New York. You're not going to be able to contribute to a 529 plan in New York if you live in Virginia and deduct from what you're contributing to that. So what have you guys heard about why somebody would want to participate in the 529 plan specifically? Let's not talk life insurance just yet. We're going to bring up the alternative, which is where we end up liking the alternative better than the 529 plan. But first, let's tackle, like, why would somebody want to participate in the 529? What's the pitch?
Well, there's several I heard. One is, of course, the one we just mentioned, the state-specific deduction on 529 plan, because that's the purpose for college funding. The second one I heard is the market will always go up. You just force your saving into the 529 plan for the education purpose. And the third one what I heard is you really have to start planning earlier instead of saying the kids, once you have kids, that's 18 years, we know they're going to need to get into college and you will need to save the amount of money to help them.
So I'll call out one specific scenario where it could make sense, and there are other options as well. But if there are grandparents that want to get some funds out of their estate, maybe they are subject to an estate tax, there are ways like where you could take accelerated gift tax options and put in very large amounts of money into one of your grandchild's or whoever's, you would likely focus on a grandchild's 529 account and accelerate your gift tax. So I think for a married couple, you could put up to $190,000 in 1 year. You just wouldn't be able to do gifts for 5 years if you do that. And that can get a large chunk of money out of the grandparents' estate and into a child's college fund. And that could have a lot of time to grow, and that could be something that the child uses. And actually, as well, at some point in the future, if you don't decide to go to college, maybe that you might do some Roth conversions if the child chooses in that account as well.
So you're talking about the accelerated use of the annual gift tax exemption, which is specifically allowed for education savings, and people can use that to fund the 529s. It could be a good option in that situation. It's fairly simple to use because you don't have to file any paperwork as long as you don't use any of that gift tax exemption over the next 5 years for those particular people, because that annual gift tax exemption applies to each individual person. Now, you also mentioned what you can do with the 529 funds if you don't use them for education. There is some ability to roll that into a Roth in the future. Now, it is pretty limited. The rules around that, a little bit tricky, but essentially, you're not going to be able to roll it into the Roth beyond whatever the annual limit is currently. So if the annual limit right now is $7,000 and you've dumped $100,000 into a 529 and suddenly the kid doesn't go to college, or maybe they get scholarships that cover the full cost of college and so they don't need that money, it's going to take them a long time to get that money into a Roth. If they could put all of it into the Roth, which you actually can't. You're actually subject to a limit of $15,000 as well, I believe, as of today's recording.
So actually, the rollover limit is $35,000, and really that's based off of, I think, 5 years of contributions. That amount will probably go up over time. So it is probably going to be based on that 5-year contribution limit. So even if the grandchild doesn't use it all for college, they'll be able to roll some of it into their Roth account, and maybe they could use the rest of the funds for other purposes.
Another thing worth to mention is if for whatever reason this 529 plan was not used, it can be transferred to other family members.
Yeah, so if you don't use it, if you don't utilize all of it, converting to Roth, you don't use all of it for your education, you can transfer it to a family member and then they can use it for education and possibly for Roth conversions as well. So there are alternatives. It does get complicated. It might take you a while to get that money out of there. Meanwhile, you are subject to whatever investment options the state offers. All the states don't give you unlimited access to the stock market to invest in these things, but some of them do have some good options. What I see when I look at typical returns, internet tells us average returns for 529 plans is around 6% interest, which that seems okay at the moment, but I see some problems with that.
So one of the issues with the 529 that I think is the biggest reason why I don't like it is when you approach the time that you need those funds. The time that you need those funds for college is a fixed time frame, and maybe the child becomes 18 or 19 when they're going to go to college. You need those funds at that time. Whatever the market conditions are, you need to start drawing from that. So you're going to put those things into safer assets, generally in one of the bond funds or inflation funds. Those are some options in my state. So those are going to have very low yields 3% maybe. So during that time, you're going to be having low returns when you need access to those funds because you're going to want safer returns.
Exactly. So most people are going to be getting into these 529 plans maybe 15, 20 years ahead of time, whenever they first start to think about saving for college. And so if most of the funds are getting into these 529 plans and they've got a 15 to 20 year time horizon, they're going to be able to be fairly aggressive with most of those funds. But there's always people that are getting closer to needing to use it, and they're going to be earning drastically lower rates because they can't risk a drop in the market suddenly wiping out what they thought was available. And so we can't look at the aggregate number, that average of 6%. We've got to look at a specific individual. If you're first starting to contribute to a 529 plan and you can't do that major dump in, let's say you're going to put in $4,000 or $5,000 a year into a 529 plan. The most aggressive years, you're not going to have very much money in that account. And when you start to get close to college, you're going to have to start dialing it down. And that's the years that you have most of the money in. So you're getting potentially the best growth in the early years, assuming the market was good during that time period. And then as your account gets bigger, you have to get more conservative. And so your overall return is likely not going to be better than that. I know at some point I looked at Oregon's average return rate, and it was somewhere around less than 2% for the 529s. It was really not an attractive option.
That's exactly why we did not continue funding the 529 plan. I do not like the restriction, which the years I'm going to use that fund will be fixed, and then it's subject to whatever the market condition. And there's so many different restrictions. Although New York, I moved out of New York. That's another reason. But for 529 plan at that time, it's still you can only use it for college or higher education. Now later on, there's a tax act, there's a change of code, you can actually use it for K to 12. But at that time, I know I have other alternate options, which will be much flexible, and it will give me a lot of control over the money.
Yeah, so I think it's time to talk alternatives. What do we like to utilize, or what do we recommend for education funding as an alternative to 529s? Carlo mentioned earlier where his preference was. He liked the IUL. Do you want to expand on that a little bit?
Sure. The IUL is a fantastic tool for children because the cost of insurance is super low and you can have a lot of time for growth, and it can be a really great vehicle, and especially by virtue of the fact that there's pretty good chance or pretty good opportunity for arbitrage. We might be borrowing at 5% and earning higher rates so that we can plan for these funds to be around for beyond college. And it becomes a great vehicle for storing wealth for our children. So that's kind of how I'm planning this out is I want to fund policies for my children so that they can have policies for college and various other things that they'll have at some point down the line for their own purposes.
I'll say talking about potential arbitrage is jumping the gun when it comes to the benefits of the IUL in relation to the 529s. That's like close to the bottom of the list for me. My main thing is it's not subject to having to earmark it for education. The funds inside of an IUL can be used for anything. So if you have a kid that doesn't end up going to college or gets scholarships that covers the cost of college, you don't have to worry about that. Also, the IUL that you're putting funds into, it doesn't have to be an IUL on the kid. It could be an IUL on anybody that you have an insurable interest in. So that's a policy that the parents own and they control the cash value. In a 529, those funds are earmarked for that person. So the IUL gives you, the owner of the policy, more control to do whatever you want with it. And of course, it can be used well beyond college years. But those are the biggest advantages in my mind to use the IUL.
Yes, and I think one of the big things with an IUL is because we have that downside protection, maybe it's 0% or even possibly a 1% guarantee. in many of these indexing strategies within an IUL, specifically the IULs that we like, you have this ability to grow and use those same indexing strategies for the entire life of the policy, because they're pretty secure assets, pretty secure indexing strategies that will have steady growth. And even if the market takes a downturn, 40% for every other asset, you might still have that 1% guarantee in that policy growing that 1%. So having that benefit, that floor, that downside protection is a huge advantage that doesn't slow growth at any phase inside of an IUL.
Yeah, so you don't have to dial back the risk inside of the IUL. We have IULs that have earned 18, 20, 25 plus percent in any given year. And that's not going to happen inside of your 529 if you've had to shift most of your funds to the bond fund that's earning 2 or 3% in a year. You just don't have the opportunity to get good growth, but we can keep that growth opportunity inside the IUL, knowing that it's downside protected in a market downturn. That's one of my favorite reasons as to the IUL advantage over the 529.
Well, my new 529 plan is IUL and then using the loan to purchase real estate properties. I will squeeze out the cash. I'll use the DSCR loan to actually get the equity out. I can get whatever I need for that year because I have twin girls. So at any given year, I have double amount of tuition if I'm helping them 100%. Maybe I'll only do 50%. That's the deal. So basically, I will leave IUL intact. It will grow. The cash value is still growing inside my IUL. And then my rental property will produce the cash flow. I will get the DSCR loan if I have enough equity. And then I probably don't need get all the equity out at any given year, but that's my plan. You can see the flexibility of the policy itself, the rental property, as well as the loan I get from the equity of those rental properties. That's exactly what my plan is for my 3 kids.
And you're really talking about the infinite banking concept there, is building out assets that you then use to fund other things, or, in the end, an education is an asset that you invest in for your children. And that's really what that is. So that's really the principles at play in how you describe your plans.
Now, it sounds like you have a good picture as to how things are going to play out, but life often throws you curveballs. So I would suggest, if your plan is to use a portfolio loan on your real estate for the college funding, do it a couple of years ahead of time, because you don't want to be doing it when you need the funding. You get the loan ahead of time, put that money back in your IUL, and it's ready to borrow when you need to for the college funding.
Definitely.
We did mention the tax advantages of the 529, and I know most people, if you've listened to this podcast, you know we have tax advantages in life insurance, but we didn't specifically mention it here. Whether it's whole life or IUL that you decide to utilize to save for college funding, we of course have tax advantages there where it's after-tax dollars going into the policy, just like it would be after-tax dollars going into a 529 account. And then in both places, it gets to grow tax-deferred. It's just the 529 funds are going to be earmarked for education. And in the life insurance cash value, we can borrow against those funds for anything that we want to do. And we do have withdrawal capabilities. But in general, the best benefits come from the ability to utilize it like a line of credit, or we borrow from it and then pay it back so that it's ready to borrow again.
Yes, I think the tax advantages for whether you're using life insurance for college funding or for other things, it's really the same. So yeah, we like to use the loans. I think it's a powerful tool for when you apply it to college funding, and really whatever you're using life insurance for, that is an advantage in general. You can tap that growth inside of your policy over many years by virtue of those policy loans.
I think that basically wraps up this topic on college funding. I think all of us prefer IULs. You can use whole life. similar situation, but IUL tends to be the preferred product for the Life Insurance Financial Education podcast when it comes to saving personally for these things. Although I'm sure any of us would be happy to help somebody if they would prefer a whole life product over the IUL in saving for their college funding for their child. Do either of you have a call to action for our listeners this week?
It's time for this week's call to action.
I think if you plan to use what we described, either IUL or whole life, talk to 2-3 agents and really get the illustration. Take a look at the numbers instead of just buy an IUL for buying an IUL. I think it's very important to look at the design. We talk about so many different scenarios in different episodes, how important the design is. It can make a huge difference on your cash accumulation.
I will say when you are looking into this, possibly getting into an IUL, and you want to compare it to a 529, you should do a little bit of research on the 529 that's available in your state, because each of these states sort of manage their own 529 plans. So the advantages could be different in different states. Learn a little bit about that in order to determine whether or not that would be good for you in your circumstance, and to have good comparisons if you were going to talk with an agent and possibly get into an IUL or a whole life policy instead.
Good points. Explore your options. That's a good call to action. I really appreciate Jing's point about checking the design. Certainly, we all mentioned we prefer the IUL, but all of us are assuming that you have a properly designed policy with minimal expenses. I don't think that an IUL would work good if it was a poorly designed policy with high expenses, because the cash just isn't going to grow in time if you have a poor design and you only have a limited number of years before you need those funds for college. So excellent point, Jing. And with that, next week, we're going to be talking infinite banking for business owners. Appreciate you joining us. My name is James Barber. I'm your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
My name's Jane, the host of Tax-Exempt Millionaire Club, a school community. We teach people how to get to that tax-exempt millionaire status. I'm also a licensed life insurance agent, and I'm ready to help you whenever you're ready.
And my name is Carlo Vaquera. You can find me at netwealthfinance.com or at netwealthfinance on YouTube. And we'll work with clients across the country for life insurance as well.
See you next week.
Stay tuned.
Thanks for watching.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.